Earning exactly $50,000 is the most dangerous financial position a digital nomad can be in right now. In 2026, that single number is the tripwire for global tax residency in 3 of the world's most popular nomad hubs. Cross it without a structure, and you will lose 20% of your wealth to countries you do not even call home. By the end of this, you will know the 3 structures that let you keep that money. For years, $50,000 was the sweet spot for geo-arbitrage. Enough to live like royalty in Bali, but low enough to fly under the IRS radar. But heading into 2027, the math has changed. Governments are hungry for revenue, and they have set their sights on the middle-tier remote earner. Look at the recent proposal to cap Social Security benefits at exactly $50,000. Moneywise.com, 2026-05-29. It is a signal that the safety net for this income bracket is shrinking, while the tax burden is expanding. In 2025, you could hide behind a vague tourist status. In 2026, that cover is gone. Automatic exchange of financial information between over 90 countries means your income is no longer invisible the moment you cross a border. This specific income level now acts as the entry point for high-tier tax brackets and visa requirements that mandate full global reporting. If you are earning in this range, you are not just a traveler anymore. You are a high-value target for tax authorities in countries like Portugal, Thailand, and Mexico. And the rules that used to protect you have been rewritten. Portugal is the first country where $50,000 triggers a massive structural shift. To qualify for the D8 Digital Nomad visa in 2026, you must earn 4 times the national minimum wage. With the latest wage adjustments, that requirement now sits right at $4,100 a month, or roughly $50,000 annually. The trap is not getting the visa. The trap is what comes after. Once you hit this income threshold, you are no longer eligible for the simplified NHR regime, which was gutted in 2024 and replaced by the narrower IFEC framework, one that targets only specific qualifying professions, not general remote workers. At $50,000, you fall into the general progressive bracket, where effective rates run between 25% and 30% on your remote income if you do not use a US LLC to shelter your distributions. The effective cost of simply moving to Lisbon at this income level is dramatically higher than nomad influencers advertise. You are paying European prices for a nomad life. And without a proper entity structure, you are also paying European taxes on income you earned before you ever boarded the plane. That is a losing trade by any measure. Thailand shocked the nomad world with its 2024 tax reform, and by June 2026, the remittance loophole is officially dead. If you are a tax resident, meaning you stay 183 days, every dollar of foreign income you bring into Thailand is now taxable. For those on the LTR work from Thailand visa, the qualifying income floor ranges from $40,000 to $80,000. At the $50,000 mark, you land in no man's land. Too much income to avoid Thai taxation. Not enough to access the wealthy global citizen exemptions reserved for high net worth applicants. The number most nomads miss is the bracket itself. Once your assessable income crosses 850,000 baht, roughly $50,000 at current exchange rates, Thailand's progressive income tax rate reaches approximately 25%. That is not an estimate. That is the statutory rate from the Revenue Department's own bracket table, and it is the real math behind the claim that your affordable lifestyle just became 15% more expensive overnight. In Thailand, that bill arrives quietly, buried in a residency determination you never saw coming. Mexico used to be the easy plan B, but in 2026, the SAT, Mexico's tax authority, is leveraging bank data and transaction records to identify de facto residents. At $50,000 annually, you can comfortably afford a house in most Mexican hubs, something nearly impossible in the US, on that same salary in 2026. The Mortgage Reports, 2026-03-25. But that purchasing power is a visibility problem. That income, roughly 850,000 pesos, places you in a progressive Mexican bracket, where effective rates climb sharply once residency is established. Unlike 2025, when most nomads cycled on 6-month FMM tourist stamps without scrutiny, the new digital identity systems make it harder to disguise your center of vital interests. If you are spending $50,000 in Mexico, you are leaving a paper trail. Bank transfers, lease agreements, utility accounts, car registrations. Each one is a data point the SAT can use to establish that Mexico is where you actually live. Without a foreign tax credit strategy in place, you could end up paying both the SAT and the IRS on the same income dollar. The double tax scenario is not hypothetical. It is what happens when nomads confuse leaving the US with solving their tax problem. And active income is not the only trap. Here is how a one-time windfall detonates your entire structure. In May 2026, news broke that Social Security back payments reached $50,000 for some retirees. 24/7 Wall St. 2026-05-16. For a nomad, a lump sum of that size is a global tax bomb dressed as good news. Most territorial tax countries, Panama, Paraguay, Georgia, will not tax it because the source is foreign. But in Portugal, Thailand, and Mexico, that $50,000 is added directly to your worldwide income for the calendar year. This pushes you over thresholds that policy analysts are now actively targeting. The CRFB proposed in March 2026 capping benefits for those exceeding certain income levels, CRFB 2026-0324, meaning you could face reduced benefits and a spiked local tax bill in the exact same year. One good year, a back payment, a contract windfall, an asset sale, can shatter a structure that looked clean on paper. This is why income separation is the foundational move. Keep your income-generating entity in a zero-rate jurisdiction, while you live as a consumer in your Nomad hub. The windfall is the test that reveals whether your structure is real or theoretical. How do you stay below the radar when you are earning above the threshold? You have to stop being a sole proprietor and start being a shareholder. Using a U.S. S-Corp or a Wyoming LLC gives you direct control over how much income appears in any given country. You decide what you distribute locally, and you keep the rest inside the entity where local tax authorities cannot reach it. In 2026, the foreign earned income exclusion covers up to $133,000 in qualifying income, but it does not solve the local residency problem in Portugal or Thailand. You need entity structure on top of the exclusion, not instead of it. Route your operating income through a Wyoming LLC or a UAE free zone entity. Both are zero rate on foreign sourced income and straightforward to maintain. Hold your liquid assets in an IBKR account under a U.S. registered entity to stay outside local financial reporting thresholds. These are not the same structure. One roots income. The other holds wealth. Conflating them is how nomads blow their protection exactly when they need it most. By 2027, the nomads who win will not be the ones with the lowest cost of living. They will be the ones who understand that residency and taxation are two entirely different things. You want the lifestyle of a resident and the tax profile of a ghost. You now know the 3 countries where $50,000 is a liability instead of an asset. But knowing the trap is only half the battle. You need the tools to build your shield. Next, I am breaking down the 3 offshore LLC structures that cost under $500 to set up in 2026 and keep your name off the local taxman's list. Subscribe so you do not miss that one. And if this gave you something concrete, hit like on your way out.